Welcome to the Deep Dive. Today, we're digging into Sable Offshore Corp. We've got their latest quarterly report, the Form 10Q ending March 31st, 2025.
All right. And our mission for you, the learner, is to pull out the really important stuff from this SEC filing.
Yeah, give you a clear, concise picture of where Sable stands right now, the challenges, the potential future, without drowning you in finance jargon.
Exactly. We're focusing on the key takeaways, maybe some surprising details hidden in the report.
So we're looking at this one primary source, the quarterly report.
That's the one. And we'll cover, well, the company's background, how it came together recently,
The business combination, yeah.
their current financial health, the big operational challenge, restarting those SYU assets, and, what might happen next. It feels a bit like a race against the clock for them.
Okay, let's get into it. Who is Sable Offshore? Symbol SOC on the NYSE, you said.
Yep, SOC. But they're pretty new in this form. Came about through a business combination, finalized February 14th, 2024, with a company called Flame Acquisition Corp.
Ah, a SPAC deal then, essentially.
Well, the report calls it a forward merger, technically. Flame was the entity that survived, but it got renamed Sable Offshore Corp.
Okay.
And right after that merger closed, literally immediately after, Sable bought the Santa Ynez unit assets, the SYU assets.
Those are the ones offshore California.
Exactly. Federal waters, offshore Cali, plus some onshore facilities. They bought them from ExxonMobil and Mobil Pacific Pipeline Company. You'll see it called the Sable EM Purchase Agreement.
Got it.
And then, boom, the next day, February 15th, 2024, they started trading as Sable Offshore, SOC. So that merger was basically their fast track to becoming a public company.
Right, a quick way to get listed and funded to buy these big assets. So a new public company taking on these, well, legacy assets. Let's look at the financials then. March 31st, 2025. What's the balance sheet telling us?
Well, a few things jump out, suggesting things are getting tighter. Total assets are $1,562.2 million. That's actually down slightly from the end of last year.
Okay, small dip.
But total liabilities, they've gone up. Now $12,281.5 million compared to about $11,199 million before.
Not ideal when assets are shrinking.
Right. And that means stockholders' equity took a bigger hit. It's down to $280.7 million from $384.2 million at year-end 2024.
Wow, okay.
And maybe the most telling number, cash and cash equivalents, they've dropped pretty dramatically from $300.4 million down to $189.0 million.
That's a big chunk of cash gone in one quarter.
It is. They also list $35.5 million in restricted cash, which is tied up for settling something called the Gray Fox matter, a legal issue we can touch on later.
Okay, but that main cash pile shrinking fast is definitely something to watch. Does the report hint at how long that might last them?
It doesn't give a specific runway, but yeah, given their spending and lack of income, that cash burn is critical.
Which brings us to the income statement. Are they making any money?
Yeah.
Any oil and gas sales?
Zero. None for this quarter ending March 31st, 2025, and none in the comparable period last year either.
Still nothing.
Yeah.
Because the assets are offline.
Exactly. The SYU assets have been shut in since 2015 because of that pipeline issue. So you've got all the costs of owning and preparing these assets, but absolutely no revenue coming in from them yet.
So what did that do to the bottom line?
Net loss for the quarter was $109.5 million.
Still a big loss.
A very big loss. Although it's worth noting, it is less than the loss they posted right after the business combination last year, which was around $180 million, but still over $100 million lost in 3 months with no sales.
Okay, so no money coming in, lots going out. Where's it going? What are the big expense items?
Well, operations and maintenance costs were up about $34.4 million for the quarter.
Makes sense if they're trying to restart things.
Right. Interestingly, G&A general and administrative costs were actually down quite a bit to $22.3 million.
Why the drop there?
The report says it's mainly because those big one-off costs from the merger itself and a settlement they had in the prior period didn't repeat this quarter.
Okay.
But another area jumped up. Total other expense, net. That was almost $39 million.
What's driving that?
Mostly changes in the value of their warrant liabilities, apparently, and importantly, interest expense.
Ah, interest. That connects back to the debt, I imagine.
Definitely. The interest expense just on their main senior secured term loan was $21.0 million for the quarter.
$21 million in interest alone. Wow.
Yeah. And remember, that term loan was a big part of the deal with ExxonMobil.
So besides that loan, how did they fund this whole thing? The acquisition, the restart efforts?
They did several big capital raises. There was a first Pipe E investment, that's private investment in public equity, which brought in a hefty $440.2 million from selling common stock.
It's like substantial.
Then they did a second Pipe E investment for another $150.0 million.
More equity.
And they also raised cash, about $183.5 million, from people exercising the public warrants, which they then redeemed. The report notes that all those public warrants are now gone, which simplifies things a bit.
So significant equity dilution to raise cash.
Yeah.
Now, back to that debt. The big loan from ExxonMobil. Tell us more about that.
Right. The senior secured term loan, it started at $625 million.
Started at $625 million.
But it's actually grown since then because of something called paid in kind, or PIK interest.
Meaning they aren't paying the interest in cash.
Exactly. Instead of paying cash, the interest gets added back onto the principal amount owed, so the debt grows over time.
Oh, okay. So what's the balance now?
As of March 31st this year, the outstanding principal was up to $855.0 million.
Whoa. From $625 million to $855 million. That's a huge jump just from PI interest.
It's significant, yeah. And crucially, that loan agreement has restrictive covenants.
Meaning rules Sable has to follow.
Basically, yes. Rules that can limit what Sable can do, like taking on more debt, selling assets. It gives ExxonMobil, the lender, quite a bit of influence or control.
So a massive growing debt burden owed to the company they bought the assets from with strings attached, and still no revenue. This all points to the absolute urgency of restarting those SYU assets, right? The ones shut down since 2015.
That's the entire game right now. Restarting production is their number one focus.
Oh, yeah.
But like we said, it's not easy.
What's involved?
Huge capital spending. For one, we saw they already spent $63.3 million on CapEx in Q1 for the restart work.
Okay.
And critically, they need a whole raft of regulatory approvals. From various agencies, that's a major hurdle.
How much more money did they think they need for the restart?
They estimate about $44.1 million in remaining startup costs.
Right.
And their target, as mentioned in the report, is to get production going sometime in the second quarter of 2025.
Q2 2025. That's
Okay.
now, basically.
Yep.
Or very, very soon. Seems ambitious given the regulatory side.
It does. And that dwindling cash balance we talked about makes that remaining $44 million spend look pretty tight.
Is there a hard deadline attached to this restart?
Oh, yes. And this is probably the single biggest risk factor. That big loan from ExxonMobil.
Yeah.
It has a condition. If Sable fails to restart production by March 1st, 2026, they call it the restart failure date,
Okay.
then ExxonMobil has the option to just take the SYU assets back.
Take them back. Without paying Sable anything.
Without reimbursing Sable for anything they've spent, all the CapEx, all the effort, gone. ExxonMobil could just reassume ownership.
Wow. March 1st, 2026. That is a serious deadline. A drop-dead date almost.
It really is. It puts immense pressure on getting those approvals and completing the work.
And given all this, the cash burn, the debt, the regulatory hurdles, this looming deadline, the report itself sounds an alarm, doesn't it? It uses that phrase, substantial doubt.
It does, and that's language you don't see lightly in an SEC filing. Because of all these factors, the approval is still needed, the timing of repairs, the financial picture, the report explicitly says, and I'm quoting loosely here, substantial doubt exists about the company's ability to continue as a going concern.
How serious is that phrase, substantial doubt, for listeners who maybe don't read these reports often?
It's very serious. It's the auditors and the company formally acknowledging a significant risk that the company might not be able to meet its financial obligations over the next year. It signals a heightened risk of, well, potential bankruptcy if things don't improve dramatically.
And they have to state that.
Yes, accounting rules require it if that level of uncertainty exists. The report also points out that the financial statements don't include any adjustments that would be needed if they couldn't continue as a going concern, like writing down assets, for example. So it's a major red flag about their financial stability.
Okay, so a ticking clock, massive financial pressure, operational hurdles, and on top of all that, they're juggling lawsuits and regulatory fights, too.
That's right. It's not just operational. There are several legal fronts. Let's quickly run through them.
All right.
There's the Gray Fox matter that seems related to the pipelines. A settlement's been approved. They paid $35 million into a fund. They've got a letter of credit for another $35 million. And the final payment is due by the end of June 2025.
So that one sounds like it's heading towards resolution, albeit costly.
Seems so. Then there's the Zaca Preserve matter. That's a lawsuit about easement access. Sable says they'll fight it vigorously.
Okay, what else?
There's the BSE matter, BSEE, the Bureau of Safety and Environmental Enforcement. That's a lawsuit challenging an extension. Sable got to resume operations and permits. The court recently denied a motion that might have slowed it down, so that case is moving forward.
Challenging their permits.
Yeah.
Not good when you need permits.
Exactly. And maybe the most active one right now is the California Coastal Commission matter.
Oh, what's that about?
It's about alleged unpermitted development. There have been notices of violations, cease and desist orders. It's messy. Sable sued the commission, and the commission sued them back.
A legal back and forth.
Yeah. And while the court didn't grant the commission's request for an immediate temporary restraining order against Sable, there's a hearing coming up for a preliminary injunction.
And that could potentially halt their restart work.
Potentially, yes. These disputes with the Coastal Commission are really critical because they could directly block the path to getting the necessary state-level permits for restart, completely separate from the financial issues.
Man, it really does sound like a perfect storm. Financial, operational, legal, regulatory, all hitting at once. Despite this, what does Sable say about their outlook in the report? Are they still optimistic?
Well, management's forecast, as stated in the report, is still aiming for that production restart in Q2 2025.
Still sticking to that timeline.
Yes. And they expect or anticipate a rapid ramp-up in operating cash flow once production starts, which obviously they desperately need.
They acknowledge the hurdles.
Oh, yeah. They say clearly that it all depends on getting those regulatory approvals, and they also flag the risk that if restart costs end up higher than budgeted, they might have to go out and raise even more capital.
Which could be tough, given the circumstances.
Could be very tough. So yeah, a lot is riding on hitting that restart target, hitting it soon, and doing it within budget. It really highlights how critical that March 2026 ExxonMobil deadline is.
Absolutely. Okay, let's try to pull this all together. For you, the learner, what are the absolute key takeaways from this deep dive into Sable's Q1 report?
I think the main thing is that Sable Offshore is at an incredibly critical point. They made a bold move buying these assets.
A huge acquisition.
Huge. But now they face truly massive hurdles getting them back online after nearly a decade of being shut down. It's not just about flipping switches. It's capital-intensive, complex operationally.
And tangled in regulations and lawsuits.
Exactly. And the financial pressure is immense. That substantial doubt language about being a going concern is stark. Plus, that ticking clock with the ExxonMobil loan deadline in early 2026, it really puts their future survival in question if they can't execute this restart quickly and successfully.
So this deep dive gives you, the learner, a real window into a company facing enormous complexity, trying to resurrect a major asset, juggling finances, battling legal issues. It's a fascinating case study of risk and potential in the energy sector.
It really is. And it leaves us with a final thought for you to chew on. Given that substantial doubt, given that critical ExxonMobil deadline, what happens to the Santa Barbara Channel energy scene long term, whether Sable pulls this off in the immediate future or not?
Yeah, what are the ripple effects?
Right. This whole situation just throws a spotlight on that incredibly intricate dance between, big finance, tough regulations, environmental concerns, and the future of offshore energy production. It's a story with potentially broad implications.